Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will speak about a new return asymmetry trading strategy for commodities.
Hello everyone, my name is Radovan Vojtko and I'm CEO of Quantpedia. In this video we will again speak about commodity trading strategy. If you remember, in my previous videos we discussed the skewness effect in commodities. This skewness effect was based on notion or based on the finding, or most of the people in financial markets prefer the positively skewed assets. So those positively skewed assets are assets that have high probability, or they have a probability of higher percentual winning. Because of that, they are usually overpriced. We show that this skewness effect in commodities has interesting performance, and then we use this knowledge and we build the skewness or rotary trading strategy in cryptocurrencies. And we show that the skewness effect exists also in cryptocurrencies, and it has also interesting performance. We really prefer to look for ideas in academic papers, try to understand those ideas, and then try to find a new application for those ideas in different assets or with different trading rules. For those of you who are interested, how does it work like, I recommend to write our essay on the creativity, collecting and design of systematic trading strategies. On this essay, I will show you another finding that we had that's built on idea based on academic research paper, on a new academic research paper. We uncovered a new return asymmetry investment factor in commodity futures. So once again, it's a new factor in commodities. The idea for commodity trading strategy is built on a paper written by Zhang et al. In 2020. The paper is named Stock Return Asymmetry Beyond the Skewness. And it's a paper that's discussing performance of Chinese equities. Out of this paper, they suggested to use a new measure of skewness, or a new measure of asymmetry, different than the classical skewness that we use for commodity trading strategy. And we like this paper a lot, and we try to apply this idea from this paper and move it from Chinese equities to commodity. What we did and what we tried and what are the results. The new asymmetric measure, shortly called AE, that's proposed by Zhang et al., is calculated to integrals, but they can be simplified. And here is the resultant equation. Don't be afraid of this equation. Let's say that we take the return over the last 260 trading days, and the resultant measure of asymmetry is calculated as a difference between two sums. So the first sum represents the number of trading days when the daily return is greater than some threshold. Threshold in our case is calculated as the average return of the commodity over the last 260 days plus 2 standard deviation. And the second sum is the number of trading days when the daily return is smaller than some threshold. And again, the second threshold is calculated as the average return over the last 260 days minus 2 standard deviations. While we calculate the measure of asymmetry, we continue. Let's try to explain what this measure of asymmetry means. So if you have a higher number, so it means that in the past the selected commodity has a higher number of days during which the commodity performance was higher than some predefined threshold, and on the other hand has a lower number of returns with a smaller performance than the selected threshold. So it means that there was a high positive asymmetry of the commodity. So in the past 260 days, the commodity with the high E measure or high asymmetry had a lot of the trading days with the positive return. So it's highly positively skewed, and it means that it will be probably overpriced. So we will short these commodities and we will go long the commodities with a low measure of asymmetry. So it means the commodities that had a lot of days, the negative performance. The empirical results are very interesting because we are using the portfolio of 22 commodities. Then we are testing what will happen if we buy certain amount of commodities in the long portfolio and we short certain amount of commodities in the short portfolio. And as we can see in this table, it doesn't matter if we select 2, 3, 4, 5, 6, 7 or up to 11 commodities into the long and also to short portfolio. We still have a statistically significant positive performance. It means that the effect is highly robust. The most interesting and the best risk-adjusted performance is when we select 1/3 of the commodities. So when we have a portfolio of 22 commodities and we select the 7 that are the most positively skewed but have the highest asymmetry, we buy those with the lowest asymmetry and we short those with the highest. We have the best risk-adjusted return. Here we have an equity chart or equity curve. So we have over 4.5 or nearly half excess return with the Sharpe ratio 0.0. 58 with a drawdown around 30%. What is the most interesting about this strategy is that it's of course not correlated to S&P 500, so that's one added value of this strategy. And another added value of this strategy is that the asymmetry measure is not highly correlated to skewness effect in commodities. So it means that the new definition of asymmetry that's based on the research paper by Zhang and his colleagues is independent from the skewness measure that we tested and that I showed in previous video. So it means that we can combine these two strategies and we can have a better portfolio. So this strategy can be a very nice diversifier to overall commodity trading strategy or portfolio with the commodity trading strategies. Thank you very much for your attention, and I hope that we will see in our next video.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.